As always, I've got a couple of things for you today, and anything else that comes to mind while I'm recording this video off the cuff, pretty much as always. I want to talk about the target unemployment rate that the Reserve Bank has at the moment, being 4.5%. And also, I have to show you this graphic and the animation with the analysis from the business of ABC. Now, you may call that a ripoff, a plagiarism, but you know what happens with these ABC, the business news is that they kept there for about a week, maybe the archive for another couple of weeks, or maybe up to a month, but probably not. I think a couple of weeks, and then it's permanently removed from the face of the earth as far as the public can see it. So I consider my channel as, documenting and recording the history. I think we are documenting and recording the fall and the burst of the biggest bubble of fall, which is a debt bubble, which you've heard about, but that is absolutely connected to the property market, which is a national obsession, especially here in Australia. So here's my thoughts about the unemployment rate, right? The government, so this is what the unemployment rate, this is the blue line here, the unemployment was in the last 10 years, right? So to cut the long story short, the government tells us that the current unemployment rate of 5.2% is nowhere near where they want to see it as a target. My conspiracy theory is that why they've moved the target of this rate to 4.5% to say this is the full employment. So that they'll say we've got the full employment when our unemployment rate is 4.5% is, in my opinion, because it's absolutely not achievable. They know that no matter how much they cut the interest rates, this is not going to happen. So why would they be doing it? Well, because the whole point and the reason why they are cutting interest rates is because they know how many people won't be able to service their loans once their loans go from interest only to principal and interest. And this is all coming up. They know that so many people are going to be in trouble, will have to sell or foreclose or do any one of those things that will push the property even lower. So they've set themselves a target of 4.5% once again and told everyone until we see 4.5% unemployment rate, we're going to continue to cut the interest rate, yet not telling us why exactly they're doing it. Why is 4.5 unachievable? When the last 10 years, it's never come even close to it. It's just gone under 5% once at the end of 2010, just here, and then it climbed back up, and then it went really just under 5% once again. So it's never been in the history, even if we extended this chart for longer than 10 years, it's never been 4.5% for. And surprise, surprise, the unemployment rate wouldn't budge. Unemployment holds at 5.2% despite just 500 jobs being created in June. So to governments and central banks' disappointment, it hasn't budged, hasn't gone towards 4.5, which is the target. So guess what they're going to have to do? Cut the interest rates once again. This is, don't be a dupe. This is why they're doing it. But they're going to do it. So prepare yourself for that. Now, here's that unbelievable animation with loads of really good information that, yes, I've ripped off the ABC TV, but it has to be seen. It has to stay on the internet so we can actually go back when things happen and see what the mainstream media was saying and what we were speculating would happen and what actually happens.
With mortgage lending making up 60% of bank books in the country, the housing market is the major lenders' bread and butter. After being on a downer for the past 2 years, back-to-back interest rate cuts and relaxed lending rules have sparked new life in the auction market. But record household debt means another boom would leave borrowers vulnerable. This special digital feature from Alistair Croy and Michael Yander.
The biggest gamble most of us make is buying a home. And it's not just our own cash we're putting on the table. Australians have the world's second highest level of household debt. That means any major financial or economic shock could make the banks big losers, along with households. Australian house prices rose rapidly over the past couple of decades. Capital city prices have increased fourfold since the mid-90s. But over the past couple of years, prices have been falling in many cities, especially after the Banking Royal Commission triggered tighter lending standards. The Commission exposed how some borrowers were being given loans they potentially couldn't afford. Other factors have also weighed on house prices, including a clampdown on money leaving China and increased taxes, which have cut the number of foreign investors. Concerns about the quality of newly built apartments, through scandals like the massive cracks in Sydney's Opal and Mascot Towers, and flammable cladding on many buildings, have dented confidence in high-rise living. A record construction boom means concerns about undersupply have been replaced with worries about an oversupply of apartments in some areas. The recent re-election of the coalition might change this downward trend.
What we won't do is undermine the value of the home you have saved so hard to buy. What we won't do is undervalue the home that you're paying your mortgage on.
Scott Morrison's promised a 5% deposit guarantee for first home buyers, reducing the amount of savings needed to get into the housing market. The bank regulators also loosened its tougher rules on bank lending, which will mean many people can borrow a lot more. And the Reserve Bank's lowering interest rates, making mortgages even cheaper.
Do you think that we've seen the bottom in the price falls?
Yeah, we've definitely seen the bottom.
Or perhaps things will go the other way. Wages growth remains low, unemployment's edged higher, and mortgage arrears are on the rise. Meanwhile, home prices keep falling across the capital cities. Either way, Australians have continued to bet the house on property, for better or worse.
All I've got to say to that is OMG. Notice the theme of this animation is the casino, the house of cards that normally falls. I got nothing else to say. They covered everything. They've covered the lack of Chinese investors or speculators or gamblers. Really, I mean, all right, let's talk about the Chinese gamblers. You know how the new Barangaroo casino was about to open or was opening, being built, and I think the license, don't quote me on this, but the license was to attract the high roller gamblers, mostly from China. Now, because the China and Chinese government, Communist Party, have clamped down on money leaving the country, doesn't look like they're going to be hitting the Australian shores or coming to Sydney, these big gamblers, high rollers. Instead, they're going to open another casino, just like the Star, that will attract mums and dads and accidental gamblers that are the ones that actually can't afford to gamble. Yet there will be another casino and the license is probably going to change or whatever. They'll have an excuse. So that's going ahead. Show must go on, and that's exactly what's happening. But the same thing has happened in the overheated, let's call it Sydney and Melbourne housing, where these overseas gamblers came here and thought that it was never going to stop going up. And just speculated into it continuously going up and up and up, and piled money into it. But the combination of the clampdown of their own government, our own government here, increasing the stamp duties and taxes on foreign investors, And not to mention with all the problems with flammable cladding and buildings sinking and cracking and poor quality. Why would you pay hundreds of thousands, million plus dollars for 2-3 bedroom apartments in Sydney? It's just beyond me anyway, but you know my stance on that. I suppose I have digressed a little bit. It is about gambling, the house of cards, the casino, the real casino, and the property market in Australia, which is a bit of a casino.
Yeah, we've definitely seen the bottom.
Now, after that amazing animation, anything else I show you is going to be a bit of a downer. However, they do have Louis Christopher from SQM Research, which is like an independent research firm or something. You've seen him a lot on TV, and we've got the some sort of chief economist or something, economist from ANZ Bank. It's not a surprise what they're saying, but when you think about it, they're not really saying much you haven't already heard. But I'll give you just little snippets as to what they think is going to happen next, given what's going on. And you don't have to be genius to kind of say that. I mean, any one of us, I am quite confident that all the viewers and subscribers of this channel, if you went on TV, you'd be able to kind of say things that they're saying, because it's like using the tea leaves to predict the future. That's all they're doing. But in my opinion, and my forecast is still that the property is just gonna go down to 40%, down 40% from peak, on average at least, or more. And we're talking probably another, I don't know, 12, 18 months. What's going to have to happen is that there's going to be a uptick in property because people are getting that shot in the arm with smaller interest rates. The confidence is back in the market a little, but when everyone recognizes and realizes that this is false hope and confidence, that's when it's going to pull back and continue to go down. People will see through the attempts of the government Reserve Bank, and they'll see that it's failing. And as they mentioned in the next segment, the investors are out of the market. So they are the speculators, they are the gamblers. So if the most gamblers are out of the market, including the Chinese investors, that asset class is done. A little bit like Bitcoin, maybe not a good point and time to talk about Bitcoin, having seen it gone from like 3,000 to 10,000 just in the last month or so. I told you were wrong. It still is a speculation because there's really nothing behind it. And the only people who are, let's say, speculating or investing in Bitcoin are really exactly that, speculators. Oh my, I've touched on a few subjects here. It's going to ruffle some of the feathers and probably will be reflected in the comments in below.
Felicity Emmett and Louis Christopher, welcome to the business.
Thank you. Good to be here.
Now, we're not going to give up this national property obsession anytime soon, I imagine. So, Felicity Emmett, I'll start with you. What's your outlook?
Look, we think we've probably reached the trough now for house prices, and over the next 18 months or so we expect to see a fairly modest recovery. It's not going to be a big V-shaped recovery moving back to sort of 10% price increases.
So no V-shaped recovery. Does that mean investors and would-be property owners have a bit of time to get back in on this next run-up in prices?
Yes, I'm not sure whether they need to really race in in fear of getting in ahead of a big run-up, because we're not expecting that. Certainly it seems as though owner-occupiers, I think, will be more active in the market. Investors still are not very interested. The finance is very weak for investors, and they're not going to get the benefits as well from the easing so much in terms of the APRA regulation. So I think it'll be really more of an owner-occupier market, at least in the near term.
And Louis Christopher, you're...
Okay, so playing it safe. I hate to be interrupting the video, but it's playing it safe. It's not going to go anywhere. It's probably just going to come back up a little bit. The investors, as I said, are definitely out of the market. It'll be owner-occupiers. Kind of tend to agree with that. Let's see what Louis Christopher says. There's actually something a little bit dangerous that he says. Again, he can say anything he wants. That's the opinion, absolutely. But there's a bit of a fear setting in by what he's saying later on. Let's have a look.
You're in the camp that thinks that prices have probably bottomed about now as well. How fast do you see prices recovering then?
Well, there is actually, in our view, a risk of potentially a new boom. The risk being that the regulators, the powers that be, are throwing too much stimulus at the housing market, and therefore potentially we could see many buyers hitting the market all at once, driving prices up. We don't know whether that's happening for sure right now. At the moment, there's not too many listings out there, and I think buyers right now are being cautious, but there are certainly more buyers, and we think there'll be even more buyers as the months go by.
You mentioned low stock levels. They have been quite low. Spring could be a big test. Can the market absorb a whole flood of new stock on the market?
We will see an increase in listings in spring, as we usually get each and every spring. I doubt though we'll hit new record highs with listings. There's still a lot of cagey vendors out there who now believe that if they hold off from listing, they'll get a better price, say in 6 to 12 months' time.
Here's the dangerous bit I was telling you about.
And Louis, Christopher, of course, that's great for people who already own a home, but those trying to get into the market, do they have much time?
They've got a little bit of time right now. Prices in Sydney and Melbourne, as mentioned, are at risk of snapping up. If they don't snap up, it would be a gradual recovery. I seriously question though the sustainability of this new recovery. In my view, I think if we were to get to the point where we're seeing annualised double-digit price increases, APRA, the Reserve Bank, would step in and try and clamp on that. They would not want to see that at all. And I do believe, given all the stimulus we've seen, we are at risk of seeing that scenario play out.
And we did.
And that brings us to a good old friend of ours, FOMO, fear of missing out. As Lou Christopher says, we've got a little bit of time to get in there before the market runs away from us once again. What do you think? I appreciate you watching. Thank you for that. Let's talk again soon. Take care.